Today we're breaking down a really deep forensic analysis from BGVC on Palantir's latest earnings. They've put the company completely under the microscope, and what they found is this fascinating contradiction right at the heart of Palantir's story.
And here's the bottom line from their report, right up front. From a financial health perspective, the company passes with flying colors. It's an A+. But at the same time, its stock valuation is seen as stretched to a dangerous extreme.
So, how is that even possible? That's the big question we're going to unpack. How can a company be a total rock star financially, but a super risky investment at the same time? It's really a tale of two different things: a flawless business and a potentially perilous stock.
All right, let's get into it. First up, we really need to build the case for just how incredibly solid Palantir's business actually is. Because when you look at the financials, it's pretty much perfect. But before we even look at Palantir's numbers, there's a really key idea you gotta know. It's kind of like the gold standard for checking if a company's profits are the real deal or if they're just, playing games with accounting.
And Palantir? Oh, they absolutely crush this test. Look at this number, 1.33. What this means is, for every single dollar of profit they claim on paper, they're actually pulling in $1.33 in cold, hard cash. Their profits aren't just real, they're incredibly high quality.
Now, what's maybe even more impressive is how they're growing so fast. You see, in the tech world, there's a pretty common playbook for growth, but Palantir isn't using it.
And this right here is all the proof you need. 0. That's the amount of goodwill on their balance sheet. So what's goodwill? Well, it's basically an accounting line item that pops up when a company buys another company for more than its assets are worth. Having 0 means Palantir's growth is 100% homegrown. They built all this success themselves, which gets rid of a huge hidden risk that so many other big tech companies are sitting on.
And speaking of being low risk, just look at their assets. The BGVC analysis calls their balance sheet a fortress for a reason. Almost 80% of everything they own is just straight-up cash or super safe U.S. government bonds. They are absolutely swimming in cash.
So, what's fueling this beast? Well, the engine is crystal clear. It's their U.S. commercial business. I mean, just look at that growth, 121% year over year. That is completely explosive, and it's all being driven by customers adopting their new AI platform.
Okay, so the company is an A+, a financial fortress, no doubt about it. But this is where the paradox really kicks in. How does all this perfection create what might be a massive problem for anyone thinking about buying the stock? This table from the report really tells the whole story. Palantir is just different. You compare them to other data platforms like Snowflake, and you see Palantir is wildly profitable. Then you compare them to traditional defense contractors like CACI, and their growth is just off the charts. They're in a league of their own, and so is their price tag.
And here it is, the number that makes jaws drop. A price-to-earnings ratio of over 400. Let that sink in for a second. Investors are willing to pay more than 400 times the company's annual profit for the stock. That is an astronomical valuation by any measure.
And look, this isn't some fringe opinion. The analysis points out that even the biggest skeptics on Wall Street, the bears, aren't criticizing the business. In fact, they praise the business. Their entire argument comes down to one thing and one thing only. The price is just too high. So where does that leave us? Well, it brings us to the real ultimate risk here. And it's probably not what you're thinking. The danger isn't that the business is going to suddenly fall apart or even struggle. No, the real risk is something far more subtle. The analysis really boils it down to two completely different kinds of risk. On one hand, you have the business risk. And as we've just seen, that's extremely low. The company is a machine. But then on the other hand, you have valuation risk. And that is through the roof. It's all about market expectations being priced for years and years of absolute perfection.
And that leads to the final verdict from this whole analysis. The biggest risk here is what they call narrative failure. Think about it like this. The stock price today isn't based on how amazing the company is right now. It's based on a story that they will continue to execute flawlessly for years into the future. So the danger isn't that the company fails. The real danger is that its growth merely slows down from, say, a mind-blowing 121% to a still incredible 90%. Now, for the business, that's a huge win. But for a stock priced on a narrative of perfection, that could be seen as a failure, and the price could get punished severely.
So this breakdown leaves us with one final, really important question to think about. When you have a company with fundamentals that are this perfect and a valuation that's this extreme, are you actually investing in the company itself, or are you just betting on a story that the market has decided to tell?